Well, hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Tuesday, June 24th, and I'm so glad that you're joining me for today's market recap. We're coming to you from a kind of overcast, but still quite beautiful Redmond, Washington, just coming from the Northeast. I know much of the Northeast and the Mid-Atlantic region stuck in a good amount of heat right about now, in the Midwest as well. I'm thankful we're not faced with those same temperatures here. It's actually quite comfortable, but wish you all stay cool and comfortable wherever you're at, whatever weather life things you're dealing with right about now. Pretty decent update for stocks, I won't lie. This was a strong up move, as the news out of the Middle East starts to get a little less, uncomfortable and a little more feeling like there's a pathway to peace and that hostilities are lightening up. Markets moving to the upside. Certain things we've been talking about, right? We've talked about how there are, the price of the major indexes has been drifting higher, but a lot of indicators have not been supporting those moves. We'll see as we look at some of the charts how some of those warning signs starting to alleviate a little bit. The Dow theory chart that we've been highlighting as a non-confirmation starting to look less like that, as both of the equal weighted ETFs and indexes are actually starting to break out a little bit. We'll look at some of those measures of breadth, how they've evolved here, what particular things we're looking at. And I would say in general, most bullish thing the market can do is go up. And I would say particularly some of those, charts like Meta that have been stalled out over the last couple weeks, those resolving higher, pretty encouraging. There's plenty of reasons why the market could go down from here, or some would argue should go down from here. But the market's pricing in a lot of optimism right now as the major indexes continue to push higher. Let's look at all the charts together. As a reminder, we're live streaming on YouTube, X, LinkedIn, and Facebook. Looks like we're coming through okay on all those platforms. I can see questions as we go. So as we're showing charts, as we're talking about different indicators, please put questions wherever you have the ability to drop a comment on any of the live streams. We'll keep our eye on that. We'll answer a question or two at the end of the live stream. We'll save some of those great questions for our all mailbag episode on Friday of this week. It is good to be back here in the home office, I'll be honest. All right, let's get to the charts here. So, I mean, pretty kind of straightforward, plain vanilla update. The S&P actually briefly touched above 6,100 today. Did close slightly below, but that was enough for the S&P to close up 1.1%. That is a strong update today after the choppiness we've experienced over the last week. The Nasdaq Composite even better, up 1.4%. The Dow up about 1.2%. Small caps, mid caps, both up about 1%. This is a pretty decent update. Strong breadth, encouraging. I mean, an encouraging set of indications here. Speaking of encouraging signs, volatility lessening. Yesterday, the VIX finished just below 20. Today, the VIX moving well below 20, closing over 2 points lower to right around 17.5. So now we're well below the risk-off threshold, which is 20. Anything above there is a concern. Anything below there, market's telling you not much to worry about. And so that's where we're left here after Tuesday's rally on lower volatility. VIX remains below 20. This would be a pretty decent market condition. You can see that when we look at the 10-year yield, which is here. When we look at the 30-year yield, which is there. This is the 10-year yield. They all kind of have that same configuration. Bonds actually opened weaker but finished stronger. So rates opened at a higher level but sort of drifted lower through the course of the equity session. The 10-year point finished today around 4.3%. So we're coming further and further down from that 5% level. The long bond yield around 4.83. The 5-year point around 3.86. So yield curve generally drifting lower. The short end of the curve remaining fairly stable. So we have sort of a flattening of the yield curve. The TLT, which is a proxy for Treasury bonds, finished higher, about 0.7%. The dollar index slightly weaker, about 0.5% lower for the UUP. So definitely a risk-on type of day. Just looking at this particular day in a vacuum. Precious metals moving lower today. Gold and silver both down. The GLD down 1.6%. Copper prices slightly higher, but everything else moving down. You can see energy prices in particular in the red. Again, as conditions in the Middle East appear to be stabilizing, what has been a rapidly escalating situation appears to be at least quieting down a bit. Again, I feel like it's still too early to decide that it's over, but at least for now, there's a big dramatic pause in the conflict, and I think that's good. But the fact that crude oil supplies, crude oil prices have not really been affected, or the flow of crude oil has not really been interrupted too much. Crude oil prices coming down quite a bit. They had been trending higher as this conflict has been brewing, as more and more concerns have grown that a big conflict in the Middle East involving some of the aggressive moves that we've seen here could impact crude oil prices. That's kind of the traditional playbook. Last couple of days coming down quite a bit as at least a ceasefire has been implemented for now. So for now, crude oil prices coming down. The USO is around 73, and we'll see if that continues lower. Energy certainly coming down after rallying significantly in the face of higher crude oil prices. Crude oil coming down, energy once again underperforming in dramatic fashion. Cryptocurrencies generally remaining kind of strong and sort of in line with equities moving higher. You can see Bitcoin right around 106,000, Ether prices just above 2,400. Those are both positive moves for the day. Looking at the 11 S&P sectors, technology at the top of the list, up 1.8%. Had some really good podcast interviews. As a quick aside, just recorded an interview earlier today with Callie Cox. I met Callie years ago when she was the chief strategist at eToro. She now works with Barry Ritholtz at Ritholtz Wealth Management. And I mean, smart and intelligent market strategist, very, very good at filtering through the noise and highlighting some of the key themes and concepts we should be tracking. And I asked her specifically about the outperformance in technology, whether she saw that continuing and why. So I'll once that episode's ready, that should be out, we'll say probably tomorrow morning, ideally. We'll keep an eye peeled for that because Callie had a lot of really good thoughts about a lot of things, the Fed, rates, risk management, over concentration, under concentration, diversification, dominance of tech and AI, a lot of other things in the middle. So tech number one, continuing its incredible run of relative outperformance. Financials number two, the XLF were up about 1.5% today. Communication services is number three, up 1.3%. Only two of the S&P sectors down. Energy down 1.3%. That's your worst performer. Consumer staples were basically flat for the day, just slightly below Monday's close. Utilities up just about 0.4%. So it continues to be a market, a bullish phase dominated by technology. And if you flip through the Magnificent Seven charts, you're going to see things like Apple, which are kind of underwater, sort of. One of the names still below a 200-day moving average, but charts like Meta, charts like Netflix, charts like, pick a semiconductor, NVIDIA. These are strong charts. Broadcom, after consolidating, appears to be rotating higher. So the average chart in that technology AI space just once again resuming a dramatic uptrend phase. Looking at the breadth data today, pretty good. And we've been highlighting here in recent weeks how the breadth has not supported this move. Days like today with a big up move on strong breadth, that's how this market starts to look a lot more bullish. The reason why it's not felt very good here in recent weeks is because the indexes have been going higher, but any measurements of support has not been going higher. Volume weaker, momentum weaker, breadth weaker. And so the way that this resolves is either price comes down, pulled down by the weakness in all of those other metrics, or price remains strong and those other metrics start to improve. But the market just really can't go up with everything else going down. So either price pulls back or those other things start to improve. Today, it's more like the other things starting to improve. We'll see if that continues through this week and going into next. That would be the bull case from here, is more days like this where you have a 3-to-1 ratio of advancers versus decliners. That's a pretty bullish day. 75% of the S&P closing up, 72% of the New York Stock Exchange, all of these shaded green because the uptrend was pretty decent. Speaking of the Magnificent Seven, we'll start at the bottom because Tesla pulling back a bit after dramatic rallies driven by a lot of robo-taxi optimism. Today pulling back a little bit and digesting some of those recent gains. Apple, I would argue, I don't think you could make much of an argument that that's the ugliest chart out of this basket. I think that's pretty straightforward. That seems more factual than an opinion to me at this point. But Apple, weakening and continuing to struggle underwhelming in terms of its performance relative to these other leading growth names. Now, on the top of the list, you have Broadcom up 4%, NVIDIA up 2.6%, Amazon, Netflix, Meta both up about 2% for the day. So a pretty decent update, driven in some ways dominated by some of those growth leadership names. All right, let's get to the heat map. As a reminder, I can see questions as we go. I see some coming through on YouTube, on X. Please keep them coming anywhere you're watching the live stream. Pop your question in the comments section. We'll keep an eye peeled. By the way, if you're watching the replay on our YouTube later in the evening, I'm glad you're here. Just put a question that you'd like us to consider for the mailbag. Just drop it in the comments section. We've had some great questions. The mailbag episodes on Friday have been a lot of fun. It's great to dig in a little more deeply to some of the great questions that you guys are asking during the day, or during the week, that is. All right, let's get to the market carpet. This is a heat map style visualization on a day like today, when 3 out of every 4 stocks was up in the S&P 500. So most of these little boxes are going to be some shade of green, or maybe kind of neutral amber. The down stocks almost jump off the page, right? And that's the benefit of a day like this, is anything that did not participate in the uptrend, something might be going on. So if you look, you'll actually find there's a number of themes that can be teased out based on which stocks are actually struggling today. We'll start with energy, which is now on the bottom sort of right corner of the heat map here. Exxon, Chevron, both down pretty significantly. ConocoPhillips, those three are the 3 biggest big integrated oil companies, all down 2 to 3%. And I think the weakness in energy, just driven by the fact that crude oil prices are coming down. Crude oil prices spike, which is pretty normal. If you say there's going to be a big conflict in the Middle East with a number of participants being drawn in, and Iran is a major actor in that, I would say crude oil prices have to be spiking pretty high. Even if there's no direct impact to crude oil supply or something, it's a reasonable expectation that crude oil prices are going to be affected. If there's very few scenarios where that means crude oil prices are going to decrease, unless hostilities start to cease, and unless we see maybe there's a concern that crude oil is impacted, and then it isn't, which is sort of what we're seeing here. There's a lot of concern that it could build into a much bigger, broader conflict. I think it's too early to say that that's not happening. I think it's too early to declare that was it, the war is over, there's no more issue. I think this is still a very tense and uncomfortable situation in so many ways. I would not be surprised if there's more to this at some point. I would expect that probably drives crude oil prices maybe at some point later. But for now, market being very optimistic that crude oil will be okay. As a result, energy stocks coming down pretty good, especially those that are driven, whose value is driven primarily by the crude oil price. Also, I would note Tesla down over 2%. Now, that's not that bad. The stock's been bouncing up pretty good in the last couple of weeks, sort of trading below the recent swing high from that's late May, around 360, 370. So I keep an eye on that swing high. Today's pulling back after a week of pretty good runs, driven by the optimism about the robo-taxi rollout in Austin, Texas. Defense stocks taking a bit of a bath here. Again, those stocks all rallied aggressively as events in the Middle East have rolled out, really from mid-April on. Charts like Raytheon and Northrop Grumman and HII and LMT have all been trending pretty significantly higher. So they're pulling back off of those recent 52-week highs, given the fact that it looks like things may be de-escalating. Again, I think the reality is we're one headline away from it feeling like it's not over, and I think panic starts to boil up very, very quickly in that scenario. So I'm a little tentative about declaring an all clear on that particular thing. But for now, reasonably with tensions sort of lessening today, that you see some of the defense and aerospace names starting to pull back a little bit. Still very good charts for the most part. Gold stocks coming down today as gold prices have come down. Newmont Mining is fresh off of a new all-time high this week, so let's not get too crazy about it. So those are the names that are actually down. What are the names that are actually up? It's a lot, but I would focus your attention on technology. We have a lot of semiconductors and others doing remarkably well here. technology, the number one sector in the S&P. Number two is financials, which is over here. And you can see a number of these names are not overextended. Some of them like Visa and MasterCard pulled back aggressively and are now starting to bounce off of those levels. We have like AXP, looks kind of like Meta, where it had this big run into May, and then it's really been sideways. And this has been a really sideways period, a consolidation phase, where the market's been telling you for the last 6 to 8 weeks, American Express is worth about $295 a share, and we're just kind of over and undershooting that equilibrium price, right? That middle. Today, we're gapping above 300, which is clearing these swing highs. And I would argue, let's see if there's good follow through tomorrow. But I think that, basically implies a retest of those January peaks as the next logical step based on that, the rally, the gap higher, which ended up being a bit of an exhaustion gap, which means it's a gap at the end of the move. We then sort of trend right around that gap range before finally breaking out to the upside. If we pull back tomorrow, back into that gap range or back into the consolidation range, I would say all bets are off. But for now, I think that's a pretty encouraging breakout over 300. So a number of interesting charts in the financial sector. Some of these like Blackstone, really not that overextended. They had good runs and then have been sideways. And the question is, do they resume their uptrend? So those are the kind of charts I would be looking at. What level? Where's that level where you set an alert that when we get above that point, that's where it draws you in and suggests you out of position if you're not there already. Those are some of the observations here on the heat map. Anything else I want to say on there? No, I mean, on a day like today where it's kind of growth over value, offense over defense, and besides the red and energy, the weakest kind of general appearances are in defensive sectors. You can see like consumer staples. There's some random stocks that were up, but overall, sort of a weaker average look. Utilities, REITs, generally underwhelming on a relative basis, and that's kind of the nature of this particular moment. All right, we're going to get to the rest of the charts here in a moment. I do want to let you know, kind of sad news. Charlie Kirkpatrick is a legendary technical analyst. I just found out he passed away last week. I just want to take a moment to respect Charlie and honor his contribution to the field of technical analysis. If you don't know him, go look up the book, Technical Analysis, the Complete Resource for Financial Market Technicians. That was a college-level textbook that Charlie co-authored with Julie Dahlquist, who's a professor down in Texas. I want to say UT San Antonio, I want to say, Julie. And I got to know Charlie, later in his career when I started getting involved with the CMT Association. Charlie was just a very generous technical analyst. He had won every award a technical analyst can win, from the MTA Annual Award, recognizing a top practitioner, to the Dow Award, recognizing contributions to the field of technical analysis, to the Mike Epstein Award, which is for service, right? Helping to educate others in technical analysis. He won all of them. Charlie, I got to know him when he was actually based near Boston in southern tip of Maine, and he taught a course at Brandeis University, one of the first college level, graduate level courses in technical analysis. Now there are a number around the U.S. and indeed around the world. Charlie had been teaching that class. He launched it at Brandeis and then invited me to take it over for him when he was ready to unwind. So for 1 year, we actually taught that course together. I learned a ton from just how he engaged with the students, made the markets come alive by talking about charts. And I was very happy to take the course over from him. And afterwards, continued to stay in touch with Charlie, visited him at his home in southern Maine. He was living the good life, living right on the water with a boat. He was so proud of his family and where he was able to retire. And I was very proud to know him. So thanks so much, Charlie, for great contributions to the field of technical analysis, making the CMT Association a very special place and paving the way for people like me to have really cool opportunities. Rest in peace, my friend. All right, let's continue on. Talk about some charts. So here, and again, Charlie would, I think, be most thankful if we moved on from sentimental stuff and talked about some charts. So let's go. Looking at the daily chart of the S&P 500, we've been highlighting this bearish momentum divergence, right? Where you have prices moving higher. You have the RSI sloping downwards, right? And this is the dotted pink line, sort of highlights that particular relationship, the bearish momentum divergence, as we've covered a number of times. And I did a video last week, 2 weeks ago, maybe, on my Stock Charts TV weekly show, talking about bearish divergences in particular. And two ways that divergences are resolved, right? And it's usually almost always in one of these ways. Either the price moves down, drawn down by the negative momentum. And so the bearish divergence is a precursor, a leading indicator of a big correction, or the market is able to resolve the divergence in a positive way by breaking out on stronger momentum. For now, it looks like that might actually be happening. This was obviously a big gap higher on the news out of the Middle East overnight, and continued upside for stocks. Here's the kicker: it's still a divergence, right? Because they're still going higher on weaker momentum. We'll have to see where this upswing ends and where this next peak in the RSI is going to be. If we have a couple more days like this, if this is what the rest of the week looks like, then the divergence has been negated in a bullish way. And I think that's a off to the races. We're making new highs and probably not stopping for a while. But if we get a pullback on weaker momentum, it's just further confirming that divergence. We're kind of at a key point where for now, it looks like we might be breaking out on stronger momentum. We have to see whether this move is enough to push the RSI higher. And that would happen only if there's enough big up days to move the momentum gauge higher. And that's what we haven't quite been able to do just yet. Important chart to watch to be sure. Another thing we've been highlighting is a bearish non-confirmation from what I call the newer Dow theory. It's looking at the equal-weighted S&P and the equal-weighted NASDAQ. With today's rally, it appears to me that the S&P, the equal-weighted S&P, has now made a new swing high and broken above the May peak. The NASDAQ 100, the equal-weighted NASDAQ 100, had already made a new peak in June. So now all of a sudden that bearish non-confirmation kind of coming off the table as both of these are now breaking out and confirming a bullish trend. The more that these trend higher, the more bullish that chart becomes. Breadth indicators, again, today the breadth was a lot more positive. Now the breadth had been pretty measured over the last couple of weeks. We had a market moving higher on weaker momentum readings. As of today's rally, and again, this is a broad move today, we now have over 50% of the S&P members above their 200-day. I have been testing that 50% level. So this is pretty encouraging that we're remaining slightly above that level. We're over 75% of S&P members above their 50-day moving average. So some of these indicators that were very, very, pretty much telling us, pullback scenario and very close to a very negative sign of breaking below that 50% level, holding for now. And again, today's rally allowing some of those indicators to hold. We'll get back to stocks in a minute, but one of my Market Misbehavior Premium members asked a question about the weekly chart of Bitcoin, shared a chart that made me want to share this particular view with you. We're talking about daily versus weekly looks at Bitcoin and some of the different conclusions you can draw by looking at some of those different time frames. One of the things we looked at was a weekly chart of Bitcoin. We're going back about 8 years or so, but I just want you to focus on the last couple years, because if you start at the end of 2022, you connect that low with the lows from late 2023. That lines up fairly well with the lows from the third quarter of 2024. That lines up fairly well with the lows from April of this year. And that kind of gives you the general pace of this uptrend. Now, these are big swings, and we're obviously compressing the price action quite a bit because we're going back to Bitcoin in 2025. So we're going back 10 years. So we're bringing in quite a bit of data. But when you look at the trend over the last 4 years since that 2022 low, it's been pretty consistent, which tells me if I still buy into the long-term story of Bitcoin, and if we do get any further weakness, that 90,000-ish level would basically be where this trend line is in June, July of 2025. That red line is the 40-week moving average, which is, almost identical to the 200-day moving average. So, potential support on the weekly chart and using moving average support right around 90,000. I think for me, if you do get more choppiness, if you get more pullback in the price of Bitcoin, maybe that's where we expect some support. Now, similar to the S&P, the chart of Bitcoin, particularly in this case, the weekly chart of Bitcoin, you can see that these moves higher in 2024 to 2025, all marked by lower momentum. Now, that's fine, and that's not too much to worry about as long as the price keeps going up. I think this gives you an idea using the weekly time frame, how much downside you have to have a tactical pullback within an uptrend phase that is still in good shape. That weekly chart might end up being one of the better ways to think about Bitcoin, to kind of manage through the short-term noise, but keep your eye on the ball in terms of the long-term trend. I was talking about Meta earlier as one of those stocks just starting to emerge from a short-term basing pattern. When I'm talking about a basing pattern, that's just a verbal shorthand for saying there was a move, and then there was a sideways period. A basing pattern is just kind of where you can draw a rectangle, and it pretty much describes the price action over a period of time pretty well. You can see that once Meta rallied, had this great double bottom pattern in April. So while a lot of other things kind of pushed right off, we had a low on April 7th and another low on April 21st. Then we break above the 200-day moving average and clear that April peak. That's when things start to look pretty encouraging. You can see we pulled back again here in late May. We then rallied up to just above $700 a share, but then over the last 3 weeks, we've been in this sideways phase, ranging between 680, we'll call it 675, and maybe 705, 710 on the upper end. Today, with the bounce higher, we're pushing above $700, above 710, and it looks to me like breaking out of that range to the upside. That's how a basing pattern resolves in a bullish way, is we have an equilibrium, we have a range of highs and lows, and then we emerge out of that range to the upside. I'd love to see a follow-through day tomorrow, meaning a higher move, continuing this breakout, ideally the volume a little bit higher than average. But overall, I would say the chart of Meta resolving positive. Now, there have been other Magnificent Seven names that have been looking quite strong for a while now. Meta just kind of joining after breaking out there. Broadcom, another one. I don't think I grabbed that chart. That's another one just starting to break out after a consolidation phase. I did a video just earlier today for Stock Charts TV on Fibonacci retracements. I don't know if that's posted yet, but I would check that out on the Stock Charts TV YouTube channel. I do a weekly show over there, usually on Monday, but today was on Tuesday. We talked about Fibonacci retracements. I didn't include this example of Applied Materials, but this looks like some of the charts that we did highlight, because if you take a AMAT over the last year, we can see the all-time high here around 253 in July of 2024. You can see the low here in April around 123, and then we can see 38.2% of the way up of that range is around 173, and that's pretty much where we hit in mid-May. And this is why Fibonacci retracements I find so valuable, right? We rallied up here. Things look really, really good. But if you look at the longer-term relationship here, and what I call a Fibonacci framework, we have an expected upside resistance around 173 to 175. That just happens to coincide with the 200-day moving average. So rallying up to that level as a swing trader, that's probably not where I want to be adding long positions. That's probably where I'm going to be either playing the short side or expecting at least some sort of pullback, right? If I'm a long-term investor, really bullish on Applied Materials, getting to this point tells me maybe today's not the day where I want to add to a long position. I probably want to pull back a little bit, wait for that pullback and opportunity to buy in at a weaker level. What's happened there, though, is since late May, we've now round-tripped back to the Fibonacci level. We pulled back yet again as we broke above the 200-day and then tested that. And then today, we've now resolved through all of those levels to the upside. So I would say Applied Materials is now completing a rotation above the 200-day, above that first Fibonacci level. That implies upside to 204, which would be the 61.8% level from last touch back in fall of 2024. So semiconductors generally have been improving. Charts like Applied Materials, not as good as others like NVIDIA, because they're still trying to work through some of these resistance areas from earlier this year and 2024 as well. But I would say today, kind of completing an upside follow through. It looks like to me, at least for AMAT. Talked about the chart of Bitcoin, potential long-term support. I just want to highlight Coinbase continued to push higher. The news on stablecoin legislation last week really injected a new wave of optimism and a new influx of buying power into Coinbase. Today, pushing higher as well. We're 12% up. I mean, at or near new all-time highs today for Coinbase, really rotating higher. Now, most recently, we had this pullback similar to the chart of Meta. We had a consolidation phase. In this case, excuse me, around 240 to 275, we'll call it. Last week, we broke out of that to the upside, and now we've had more and more follow through. I think that's a bullish chart. Maybe we get some pullback off of these previous highs, but I'd say that's a chart innocent until proven guilty. On a chart like this, by the way, what I kind of do, a couple things I would do, if you own a name like this, which I don't, but you own it and you're like, I want to make sure I don't give back all of those gains. Two things you can do. You can just start drawing trend lines off of the lows. It's not a perfect, trading system, but what it will do is just, general thought here, as long as we remain above that trend line, conditions are overall okay. If we break the trend line on a pullback, excuse me, then the uptrend may be brought into question. Overall, I would say this is still a pretty encouraging chart. Higher highs, higher lows, above an upward sloping trend line. That's encouraging. All right, I have one more chart, Alphabet. This is one that I actually think I used in that video, but I forget. It's kind of a blur. Alphabet, as we highlighted on yesterday's show, I want to say, pulling back to Fibonacci support. Here's the 38.2% level based on the framework from earlier this year. That served as resistance a number of times. We finally broke above it, and that became support, and that support is being tested yet again this week. For now, we're holding that Fibonacci level. For now, we're holding the 50-day moving average. I think as long as those hold, and the RSI holds 40, this is setting up as a really good short-term potential bounce back above the 200-day, maybe even back up to the 61.8% level. It's where the mid-June high was. I wouldn't be that afraid to take that sort of shot based on this setup, based on the fact that I don't have a short-term RSI, but we're probably at an oversold level on a shorter time period. But I would point out that I think we're at the lower end of sort of the reasonable range based on this breakout. Anything below here, and you start to have to really question whether we're going to deteriorate back to those previous lows. No real divergence or anything going into the pullback over the last week, but I would say the fact that we're kind of stabilizing here suggests to me at least a short-term bounce. See if we can get above the 200-day moving average. That would make that a much more encouraging chart. All right, some great questions, and I appreciate the kind words about Charlie Kirkpatrick. He was a good friend there, and I appreciated my time with him for sure. Let's look where else we can find. I love this. Holding Broadcom is like holding a firecracker. That's a tough analogy right there. That's brutal. Rohit, thank you so much for watching on YouTube. You asked how long before your long-term models for small and mid caps would turn green. That's a good question. Let's take a look, shall we? So here is the Russell 2000 ETF. I'm going to use my version of the chart, which I like a little bit better than this one. Just a little bit easier to see. Here's the chart of Russell 2000. So here's the problem, right? Is while the S&P and the NASDAQ had really good runs and they pull back, the small cap index pulled back way more. And so the 2025 pullback is really dipping much further back down to those 2023 lows. For the S&P and the NASDAQ, it's not nearly that negative, which is why the long-term model actually turned bearish in March of this year, while it did not turn bearish for large caps or for the NASDAQ 100. So what's happened now is we've rallied off of that early April low, enough for the short-term model to turn bullish. That actually happened pretty soon after the lows. The medium-term model turned bullish in May after enough of a rally, but the long-term model still not quite there because of the significance of the drawdown. It was just a much deeper move, compared to the historical framework for small caps and mid caps. So we would just have to have a little more. It's very, very close. I mean, it's very close. It could be one big week away from breaking higher. And this is actually measured by the 21 and 34 week exponential moving averages. The 21 is in red. The 34 week is in purple. So we'd have to, get enough of an upside that it would draw all those exponential averages higher. So just have to be more of an upside to be honest with you. In terms of the market trend model, the most important one is the S&P, in my opinion, and that one bullish on all time frames. For the NASDAQ, bullish on all time frames. It's just the way that we've had the different structures have made small caps and mid caps not as attractive using my model versus large caps. And year to date, large caps have definitely been the place to be. So I feel like I'm emotionally okay with that. Richard, thanks for watching on YouTube. You said FedEx has reported. Can you review? Yes, thanks. I forgot about to highlight some of the names that are reporting this week. Apologies for that. So let's talk about the chart of FedEx going into today's report. We'll check the after hours to see what's happening. But here's the setup on the way in. So FedEx has had enough of a rally off of the April low to get above the 50-day moving average. We're nowhere near the 200-day. So compared to a lot of other charts, not as good of a setup. I think the thing that's bugged me about the chart of FedEx is this kind of move right here. We gapped higher in May, but then immediately sold off. Do you see how that gap day, right? We gap up. We got all the way up to like 237, but then we haven't even tagged that level in the month since, right? So that gap up was met by a bunch of sellers. Look at a bunch of other charts. You'll see a gap and run where we gap higher and then a bunch of new buyers come in and are pushing prices upward and upwards. This is the worst outcome, which is the gap and fail, right? We gap higher, but then no one's buying, right? Like whatever happened here from this date to the next wasn't an influx of new buyers saying, wow, I'm thrilled to own FedEx at 235, because if that would have happened, then the price would have gone up. People are saying, thank God I can unwind this FedEx position and move on to something else. And that's what caused it to go down below 215. Now we've kind of come back to the upper end of this range today, kind of giving back some of those gains during the session. Let's look at what happened after the close and see what sort of move, we had here. Yeah, it's down about 5% today. So what concerns me going into today's report is the fact that we're closing near the lows of the day. And now it looks like we're trading down around 218, which means we're down around the 50-day moving average here. So not a great setup going into earnings. And the fact that we're up to the previous resistance where we failed the last time during the day today, it's a weaker chart, right? It's a weaker close. So we opened up here, but closed down at the lows. Not a good look going into earnings. The RSI is hitting 60, which is kind of the upper threshold in momentum if we're still on a bullish chart. So I think the setup on FedEx is not particularly good. When we've had this rally, this is the kind of chart that looks really good if and only if we can get above those previous resistance levels, and we haven't. That's why I always say on a chart like this, I'm always like, if we can get above that level, that would tell me, okay, there's now enough buyers coming in. We're kind of pushing above previous highs. That wasn't the setup going into the after hours here. That's how I would think of that one. And boy, that's the time for today. I do see a couple questions we didn't have a time to get to. I'm going to put those in the mailbag if that's okay. And hopefully we'll make some time on Friday to answer it. Thank you guys so much for watching the live stream. Thanks as always for the thoughtful questions. And thanks for supporting me and Market Misbehavior. Keep the questions coming. We'll do an all mailbag episode on Friday. Keep your eye peeled for my latest podcast interview with Callie Cox of Ritholtz Wealth Management. Great conversation. I'm excited for you to get your hands on it as soon as I can release it. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.